Yo, what's going on, guys? Welcome back to day 11 of the mentorship. So today we're going to be going over what mitigation blocks are, how to use them, and just overall, how to trade them and things along those lines. So if you haven't watched the previous videos, I would highly recommend to go ahead and do that. And also leave a like and subscribe on the video. And also leave comments down below, whatever you guys want to see, any feedback that you guys may have. So yeah, that's pretty much all I got for the introduction. So let's go and get started here. So mitigation blocks. So these are basically areas in price where big players like banks and institutions come back to, I guess, finish their business. I wanted to explain this in a way that you guys can understand, kind of dumb it down a little bit, just a way that you can understand it in an easy way. So when price moves fast, they don't always get their other orders filled, right? So they come back later towards that area in price. This will create opportunities for you as a trader, and you can actually take advantage of these moves to take profitable trades, right? So think of it like this: if a store has leftover items in the back room that didn't get sold during a big sale, they're going to bring them out again, right? The market works the same way in relation to mitigation blocks. When price rushes up or rushes down, there are leftover orders in those certain spots, and the price often comes back to pick them up. Here's how it works and what you should watch out for, okay? So think of it as like unfinished business. When the market moves quickly, big players can't always get their buying or selling done at one time, right? They'll bring back price to these spots to later finish them up, okay? So there are key areas and very important areas that you need to watch out for. And these are levels that are usually places where price paused or turned around before making that large move. So watch for those spots. They're like signposts, So there's also choppy moves as well. When price moves fast, it leaves gaps or uneven areas in the charts. These gaps are like unfinished chores, I guess, right? These fair value gaps that I told you before, that they can either fill and then go higher, or they can inverse, right? So the market likes to clean them up by coming back to those levels, okay? So let's just give you like a visual representation here of what a mitigation block is on just for like a line, right? So for a bullish mitigation, it's going to look something like this. So you're going to have a low put in, you're going to have a high, you're going to have a lower high, and then a higher high. So the actual mitigation of what you're looking for is the B to C leg of this whole move, right? So you have the A, the B, the C, and the D. So it's going to be the B to C, and ideally what you're going to want to wait for is for price to come down into that level. If I could pull out this thing here. Wait for price to come back into this level, and then this would be your key level, which then you could take a trade off of towards the drawn liquidity. The same concept applies for a bearish example. You'll have a high, a low, a lower high, and then a lower low. And then obviously the same thing applies here. It's going to be B, C, right? You mark the mitigation. Price will then come back up into that mitigation as the key level, and then from there you will get your entry towards the drawn liquidity or whatever it is lower. It's basically a reverse breaker block, because as you know, a bullish breaker is a low, high, lower low, higher high. So for the mitigation, instead of price coming down and doing the breaker, it's going to create a failure swing, which is the lower high. And that's really all the key differences between the breaker and the mitigation. And like I said, you could just use the mitigation as your key levels. You can think of them as areas or as traps, and just kind of a lot of resting liquidity, right? So these spots are often near places where traders set tons of stop losses, just like above a recent high or below a recent low. And big players know this and use it to their advantage. So if you can actually come up and use it to your advantage and know how they play it, at that point you could just take great trades. You could use those as key levels, like I said, or kind of formulate your own model around that mitigation, or whatever type of model you want to use, right? So the best times to watch out for these. So these moves usually happen when the market is busiest, or within a certain kill zone, like 9:30 open or like 10 a.m. open. Within that 9:30 to, I would say, like 11:30 zone, like within that first 2 hours of market open is when the most volatility is actually injected into the market. Sometimes London does decent moves, but it really just depends on market structure and where price is at the current moment, and obviously New York, like I said. So pay attention to those times, okay? Now the trick is to wait for price to come back to these spots, like I said, and then look for signs it's going to reverse or continue on, right, towards the drawn liquidity. A lot of the times mitigations will play a part during a continuation and not so much at a reversal off of a key level. Sometimes there can be a point in the chart where you'll have a higher time frame mitigation, and then on a lower time frame you could use that to frame a reversal, and take whatever draw liquidity you want to take, right? The trick is to wait for these is to wait for price to come back to these spots to look for signs that's going to reverse, like a quick bounce, or price slowing down, accumulating, waiting for the manipulation, and then trading the distribution. Don't get in too early, because a lot of the times people will enter a little bit too early, they'll set their stop, and then price will come back down one more time, stop them out, and then make the real move. So let the market show you what it wants to do, and all your job is just to react. That's your job, is just to react off of it, okay? You're not trying to predict, you're not trying to do any of that, just react, okay? So keep your stop loss just outside of those levels so you don't lose too much if it doesn't work out, right? Risk management is key. You want your winners to outdo your losses, okay? So let me go ahead and let's go ahead and find an example, let's say like on a 1 minute chart for you guys here. So if you look right here at this high, let me remove this so it's a bit cleaner. So you have this point of area right here, this area of interest. You have the high, the low, the lower high, and then the lower low. So just like I showed you with the chart examples up here, all you're going to do is mark the B to C. So right, you have A, B, C. So you mark B to C, and look what happens. Price trades back up into the mitigation, and what aligns with the mitigation? This fair value gap right here. So the fair value gap aligns with the mitigation, right? Has a lower drawn liquidity, aligning with the trend of the market, and what? Price comes up into it and then trades lower. Sometimes, if there isn't a PD right here like this fair value gap, price will come up and tap the midpoint of it, which does happen quite a bit, but you have to be discretional with the way that you're trading and the way that you look at the markets, and kind of come to that conclusion and just really wait for price to react. Because like I said, it doesn't matter. Sometimes it'll come up, there's an order block or a fair value gap. Sometimes it'll come up to the middle. It really just depends on where price is. So the same concept applies for a bullish example, right? Here's another example right here. We have our low, our high, our lower high, and then our higher high. So we mark the B to C leg, and look what happens. Price does not come back down to the midpoint because of what? Because of this fair value gap right here holding price up. So this is your bullish mitigation, and this is your bearish mitigation. Again, this works in any time frame. 1 minute, 5 minute, 15 hour, 4, it doesn't matter, because price is fractal at the end of the day, okay? Now, that's really all mitigations are. It's not super complicated. All I use them for personally is just framing them as key levels to then take an inversion off of, or change the state of delivery. But for the most part, I just like to take inversions because that has the highest win rate for my personal trading. But yeah, I mean, that's really it for mitigation. I don't want to make this video too long or too complicated. I want to just make it as simple as I can for you guys, just so you don't have to overcomplicate it for yourself or overthink it. But of course, don't always think of it like a pattern. You need to be able to use it with overall narrative and drawn liquidity, or else it's not really, most of the time it might not work out, right? Because I'm sure you could go on your own and find tons of mitigations with that same pattern that I showed you up there, but a lot of the times it might just trade right through it and then go the opposite way of where you thought the price was going to go initially. So yeah, that's all I got for you guys for mitigations. It's really not too complicated. Again, they're just areas where price wants to come back to rebalance to, and if you can align it with another PD rate, it's even more high probability. So yeah, that's really it. I'm also going to release the day 12 video today because I was a bit busy yesterday with other stuff. I wasn't able to post this video at all. I wasn't even able to record it yesterday, so I'm going to get both the videos out today, 11 and 12. And yeah, I'll leave it, boys, with that, and I'll see you Monday, tomorrow for trading, and hopefully we get some good moves tomorrow. So without further ado, I'll leave you boys there, and yeah, hope you had a good day. Peace.